Wow, what a week. We saw some huge milestones in the major markets, but the global picture is definitely getting more complicated. So, in this briefing, we're going to break down the key events driving stocks in the US and Japan and what it all means for the rest of the world. Okay, let's get into it.
Okay, the number of the week, for sure, was 47,000. That's the big psychological wall the Dow Jones Industrial Average just smashed right through for the very first time, all thanks to a fresh wave of optimism in the U.S. market.
And this wasn't just a story about the US. Half a world away, in Japan, the TOPIX index also shot up to a new all-time high. Seeing them both rally like this at the same time, that tells you there's a really powerful risk-on feeling taking hold in two of the world's biggest economies.
Okay, so what was really behind these record highs? And what was going on everywhere else? Let's take a quick look at the global scorecard to see how all the pieces are fitting together. Now, looking at this table, something really jumps out at you, right? It's this clear divergence. We've got this incredible rally in both US and Japanese stocks, but then you look at the currencies, and they're telling a whole different story. The yen just kept on sliding, weakening past 152 against a super strong dollar, and that really just hammers home how different the policy paths are for these two economies. All right, let's kick things off in the US, because this whole rally, it pretty much lit up because of one single super important number on inflation.
And here it is. The September Consumer Price Index came in at 3%, just 0.1% below what everyone was expecting. Okay, 0.1%, that might not sound like a huge deal, right? But in this kind of market, that tiny little downside surprise was all it took. It just completely reignited those powerful hopes for a Fed rate cut.
And this quote really gives us a peek into what the Fed is thinking. Right before that inflation data dropped, Chair Powell was already flagging the softening labor market. When he comes out and specifically points to unemployment potentially going up, he's basically sending up a flare to the markets, saying, hey, the conditions for a rate cut are starting to line up.
And believe me, the market got that message loud and clear. Traders went right ahead and priced in a 100% chance of a cut at this month's meeting. And now, they're looking at about a 50-50 shot for another one before the year is over.
So while the US was all about the Fed, over in Japan the excitement was coming from a totally different place. It wasn't about central banks, it was all about government policy. The rally there was really driven by a major political shift and all the economic hopes that came with it.
So on October 21st, Sanae Takaichi took the helm as Japan's new prime minister. And she set the tone right out of the gate, making it clear that her absolute #1 priority is tackling the rising cost of living that's hitting Japanese families.
Naturally, her economic plan got a nickname pretty fast, Sanaenomics. The basic idea here is to keep the big picture growth policies of Abenomics, the monetary easing and government spending, but, and this is the key part, with a much, much sharper focus on giving direct help to middle-class folks who are really feeling the squeeze from inflation.
So what's the big takeaway here? These policies are all about immediate relief. I mean, we're talking about things like cuts to the gas tax, subsidies for utility bills, and direct help for lower-income families. It's a very clear signal to the market that the government is going to be super proactive in trying to boost consumer spending, even while they're still working on those longer-term goals like defense. Okay, so we've got rallies in the US and Japan. But if we zoom out and look at Europe and China, well, the picture looks a whole lot different. It's a pretty stark contrast, actually.
Both of these massive economic blocs are running into some serious headwinds. In China, growth is slowing down as that property crisis just won't go away, and shoppers are keeping their wallets closed. And at the same time, you've got the Eurozone, which is pretty much just treading water. Germany, its biggest economy, is right on the brink of a technical recession. And the ECB, they seem to be stuck on hold, just waiting to see what the fallout from their past rate hikes will be.
And the IMF's latest global forecast really puts some hard numbers on this divergence. When you look at the 2025 forecast, you can see the U.S. economy is looking surprisingly resilient. It's expected to grow at 2%, which is way ahead of both Europe and Japan. It really reinforces this idea that we're living in a multi-speed global economy.
So that brings us to the week ahead. And let me tell you, it is absolutely jam-packed with events that are going to test all this optimism. This week could really set the tone for the rest of the year.
I mean, just take a look at this calendar. We've got the Fed, the Bank of Japan, and the European Central Bank all meeting. And if that wasn't enough, you've got these super important diplomatic summits between the US and Japan and the US and China, plus key inflation and growth numbers coming out of the States. So yeah, I would definitely expect some volatility.
So if you're an investor trying to figure out how to navigate all this, it really comes down to two main paths.
The main scenario, the base case, is this soft landing everyone's hoping for. That's where inflation keeps cooling off, the central banks can start cutting rates, but the economy doesn't just fall off a cliff. That world is good for stocks. But then there's the risk scenario. That's where some kind of shock happens, maybe something geopolitical, or maybe all those past rate hikes finally bite hard and cause a sharp recession. If that happens, you'd see a big pivot to safer assets, like bonds and gold.
So, the big takeaway here is this. While things are definitely looking up in the US and Japan, the paths of the world's major economies are clearly splitting apart. And that leaves all of us with a really crucial question as we head into the next few weeks. As the world stops moving in lockstep, is your portfolio ready to adapt to that change?